This was my very first investment in September 2017, nearly 10 years ago, and I've now invested for 107 months in a row. It all started when I got auto-enrolled into a workplace pension, and since then, over the last 9 years, I now have nearly a £200,000 investment portfolio. Hopefully by the time I actually edit this, it'll tick over, but it still hasn't yet, unfortunately. It's pretty mental. I didn't inherit any money. I didn't really do anything special. I just simply got started, invested more over time, there's been some good market returns, and here we are. So this video is going to be relatively unscripted. I've jotted down about 10 or 15 of the most important things that I've done to actually build up that pot over time. Some of them are simple, some of them are more complicated. There's a couple big things I did that I got massively wrong, which I'm hoping you can avoid. There's also, I guess, a reason why the second 100K has come a lot quicker than the first one, which I'll get into. But yeah, an unscripted video, just 9 years of investing, and I'll tell you exactly how I got to this point. I'll also put up some social proof, just so you know I'm not BSing you. Of course, I wouldn't do that. And if you need the hand of investing, check the first link in the description, chuck your email in, and I'll give you a free guide, course, and cheat sheet, all for free, to help you get started on your way. And even if you are already investing, it will still help you out, particularly the email course. There's a nugget a day for 30 days, and it'll give you a few good things to think about. The last caveat, none of this, of course, is financial advice, and I am not a financial advisor. So let's get into it. And the first thing really is that in the first couple of years, I pretty much got everything wrong, but luckily I was dealing with very small sums of money. I'll chuck them all on screen. There were honestly so many. This was back in 2017 and 2018. Made them all. I think it's almost like a rite of passage where you sort of have to make these mistakes. Seemingly everyone I talk to also makes the same mistakes. So I guess it's just one of those things. Hopefully, if you are just starting out, you can avoid these on the screen. But the biggest one and the most expensive one was trying to time the market. Now, don't click away. I know you've heard the time in the market beats time in the market, but I genuinely experienced this firsthand in 2020. The market crashed when the pandemic started. The stock market essentially fell off a cliff overnight. Probably the steepest, it actually was the steepest and quickest crash in history. And I had cash because I was working at the time in my full-time job on my grad scheme, training up to become a chartered accountant, and I held off investing. The market then bounced back and I missed out on loads of gains because I thought the market was going to keep falling. And this is the thing with time in the market, and I actually heard this on the podcast recently. If you sell 50% of your portfolio right now because you think the market's in a bubble, if the market goes up, you're going to be gutted, and often the market does go up. I'll cover that in a separate video, why the market is regularly at all-time highs. But secondly, if the market does actually fall, you will not invest because you'll be so nervous. I remember that crash back in 2020 and other sort of dips and falls. Everyone's panicking, everyone's pooing themselves. So when the market does fall 10%, 20%, 30%, when do you actually get back in? That's why time in the market is so hard. And also the best days often come right after the worst days or in and amongst the worst days. So I would just say, be consistent, don't try and time the market, and just stick with it. If you can't stomach a large drop, that's no problem. Everyone's risk tolerance is different. Just adjust your asset allocation. Have more bonds or some bonds rather than all in stocks, because then the drawdowns shouldn't be as big. The next one is that getting started is genuinely the hardest step because you've probably been overthinking things in your head for potentially years and putting it off. But once you do get started, the next hardest thing is actually staying the course and staying invested. I mean, in my relatively short, I guess in the grand scheme of things, 9-year investing career, it was just after Brexit. There was then trade wars, there was then a global pandemic, there was then record high modern interest rates, record high modern inflation. There's been multiple wars going on. There's been presidents, budgets, prime ministers. It's crazy how much has happened over the last 9 years. And I'll chuck a chart up of the global stock market right now. I haven't even got this chart to hand, but it's probably up, I'd say, hundreds of % over the last 9 years. And that is why you need to ignore the noise. As Jack Bogle famously said, the founder of Vanguard, he said, don't do something, just stand there. He also said, don't try and find a needle in a haystack, buy the whole haystack, which is why I love global index funds, and we'll come on to that soon. But you don't need to do anything, just stand there, keep investing, and keep being consistent. I think another important point as well is that in those early years of investing, it is genuinely quite demotivating and slow. You're gonna invest £100. I mean, I started £100 a month in my Vanguard stocks and shares ISA once I'd made all the mistakes in the first year or 18 months, but it's going to build up so slowly. You're going to make a few pounds here and there. It is honestly going to feel pointless. I think the first probably 4 or 5 years of me investing, it just felt pointless. It was taking so slow. There'd be a dip or a crash and my return would be gone overnight. Then it would bounce back. There was so much going on, but you sort of have to stick with it. If you are in the fortunate position where you can invest 4 figures per month. You are going to grow your portfolio very quickly and you're going to get to 100K in no time at all. But if you're like me and like I guess most people watching this and you're starting with £100 a month or less, it's genuinely going to take a while, but please just stick with it. Because then all of a sudden now 9 years has gone by, I've got 6 figures and it's mental. But also on that, you might have more invested than you realize. Your workplace pension is being invested and you probably get an employer match. If you then put extra money into a stocks and shares ISA, maybe even a stocks and shares lifetime ISA, you actually might be building up more pots quicker than you realize. And that's why I think it's so good to actually track all of this in my own portfolio. I track everything pretty religiously. If you see my portfolio updates, I do get quite nerdy with it. But the main 2 things to track, in my opinion, are how much you contribute each month to your various pots and how much each pot is worth at the end of each month. I do it monthly, you could do it quarterly or annually, but that helps me sort of stay motivated because I can see over time my pots are growing and what I'm contributing over time as well is growing too. Well, actually up until this year, 2026 is going to be my lowest year in a while. But when I was working as a chartered accountant and my salary was increasing from 21 to 2026, I was consistently investing more and more each year, which kept me motivated and kept me investing. Speaking of keeping me investing, the next one is that automation is just so key. It ultimately removes the worst enemy, which is yourself. And the reason why I think this is important is because a lot of people like to invest manually, but what's gonna happen is you'll get to the 15th of the month, that's your investment day. If the market's down a bit, you might think, oh wait, I'm gonna wait till it drops further. Or the market's up a bit, you might think, oh wait, it's just gone up, I'm gonna wait till it comes down. And then all of a sudden, you haven't invested. So I just think automation takes the human psychology and emotion elements out of it, and it's probably actually been the number 1 factor how I've been able to actually build my portfolio. When I was doing exams at uni, doing my chartered accountancy exams, working away, even in Australia, everything was just automated and it made my life so much easier. Speaking of that as well, the next one is that what you actually put in, your own contributions, matter more than the market return. And I'd almost say ignore the returns, especially in those first few years, even those first 5 to 10 years. And the reason why I say that is, speaking from my own experience, when I got to 100K invested, which was in February 2024, about £74,000 of that was my own contribution. So roughly 3/4 was money that I put in, or my employer put in with my employer match, into my various accounts. Now, of course, it's still great that I got £26,000 of gains. That was over around 6.5 years of investing, but most heavy lifting was done by me. What's now amazing though is I'm now nearly at 200K, hopefully by the time this video comes out, but I'm so close to it. And I've contributed a further £45,000 roughly. I will work out the exact numbers and flash them up on screen. Now that's still a lot of money, but I've contributed a lot less compared to that first 100K. And that's because ultimately when there's good years in the market, the gains and the compounding start to take over. And this is only going to get bigger as time goes on. Now, the double-edged sword to that is when there is a big crash, and I've not really experienced a proper big crash yet, since I've got to these high 6-figure levels, or now nearly multi-6-figure levels, I'm going to probably lose maybe 50 grand, maybe more on paper. So I'm actually interested to see how I'm going to be able to stomach that. I do, of course, think that I'm financially educated. I want to stick to the plan, not panic sell. So I do believe I will stay invested and keep investing. So that's just me just being transparent. It will be interesting to see how I react when there is the next big crash, because the market does crash over and over again. Unfortunately, it's just what it does. And the fact that I'm pretty much all in global index funds and ETFs, I probably will experience a few 30 to 40% crashes, maybe even more, quite a few of them probably over the next 20, 30 years of investing. But the point I was trying to make here is your actual contributions are the most important thing. So rather than focusing on those returns, like 4% up, 5% down, whatever, just focus on getting more money in the market, particularly in those early years, and then eventually compound interest will start to take over. But even on that point, compound interest might not take over for a decade, maybe longer. I think that's also a bit of a lie that people say. It is definitely magic and it's the eighth wonder of the world, but it needs time to work, and often a lot of time to work. If you plug in your current portfolio number into the calculator site or any other compound interest calculator and put 30 years, and then change it to 40 years, you will see how exponentially your portfolio grows. And that is why, even though compounding has started to work for me, I'd say slowly, it still could be another sort of 10 to 20 years until I fully experience those explosive years. But that unfortunately is just the truth and the nature of long-term investing. And of course, there's no such thing as a get-rich-quick scheme. And if anyone's trying to give you a guaranteed rate of return or promise you something, run for the hills, because it's just a Ponzi scheme and you don't want to get Bernie Madoff. So coming on to that haystack point, and as I mentioned, own the haystack, not the needle, or don't look for the needle in the haystack, just own the whole haystack, as Jack Bogle once said. I made so many mistakes at the start. I was investing into individual country funds, investing into individual stocks. Now that's fine, and you can do that. You can adopt a core satellite approach where you have some satellite positions where you try and do that. But now I essentially just have all of my money, about 93% of my money on my total portfolio, just in global index funds and ETFs. A lot of that money as well is in tax efficient wrappers, so I'm getting advantages, whether that's through a pension or an ISA. Now, the bit that's really helped me is I've taken on more risk. So particularly my workplace pensions. In both of my old workplace pensions, I switched from the default fund to a 100% global equity fund. And essentially in all of my investment accounts, even when I was in Australia, I've always just held 100% global stock, global equity, index funds and ETFs inside those accounts. Now, the reality is I've been quite lucky because the returns have been very good over the last 9 years, particularly over the last few years. And future returns are always unpredictable. No one knows what's going to happen. But looking back of my nearly 200K portfolio, around 70K in total of that has come from gains from the market, which is just mental to think about. But the big thing here is there will be volatility, and there is massive volatility. Even at the start of 2026, when there was a dip, I lost about £10,000 on paper in the course of a couple of weeks. So as I mentioned, once your portfolio gets bigger, it is great and you can grow it quicker, but also the volatility and the drawdowns become a lot bigger too. So you need to be able to almost deal with those. And I think that's why financial education and staying in tune with all of this stuff, even watching this video, is just so key, because the biggest risk really is panic selling, chopping and changing your approach, chasing what's shiny at the exact wrong time. Okay, let's rattle through a few now. So firstly, unfortunately, boring works. I could hold 10 different funds and 10 different stocks and make these videos more exciting and my updates more exciting, but ultimately the boring approach of global index funds and ETFs takes zero time on my end, and it ultimately works to grow my wealth over the long term. Fees really do matter, and it's one of those things actually where I find when I speak to people, they don't mind paying higher fees sometimes to the likes of Vanguard, AJ Bell, Hargreaves Lansdown, because they have bigger pots or because they want the customer service or being able to speak to a human. And honestly, a lot of people sort of bash on those companies, but I think that's fine. Paying higher fees for things that you actually want and take use of and value is completely fine. But saying that, of course, if you can pay lower fees, whether it's using those brokers or other zero commission brokers, then the more pounds or the lower you pay in fees, the more pounds you keep in your pocket, and the more that will compound over the long term. And I think really the big marginal gains here for most people are once again in their workplace pensions. I probably need to make a whole new video on that. I done one last year, but workplace pensions, I was looking at someone today actually, someone that's in my Investing Academy, which is going on at the moment, and they were paying a 1% fee for the fund they're in, which is just crazy. You can get a global fund now for as low as 0.07%, but the most you really want to pay for a fund, to be honest with you, is probably 0.3% at the most. I mean, I'm a big fan of the FTSE Global All Cap, which is a 0.23%, and the reason why that's slightly high fee is because of the small cap stocks that are included. There's over 7,000 stocks in that global fund. It's the most diversified global index fund for us as UK investors. Going on a tangent there, but long story short, I think the workplace pension that people have is where they can make massive fee cuts. And in my own workplace pensions, I've had one with Legal & General and one with Standard Life. And in both of them, I cut my fees by about 0.5% to a 4%. And that has saved me a load of money over the years. So that is probably the starting point and the lowest hanging fruit. Actually log into your workplace pension, see what fees you're paying, and see if there's anything you can do to reduce them. And also see if the fund you're in is right for you. If you're happy to take more risk, you might be able to increase your returns over the long term. Wrappers matter. Always wrap it up, of course, and that goes for investing as well. Your ISA and pension allowance are pretty massive, 20K and 60K respectively, and the more you just get into those pots and those tax wrappers, the more tax advantages you're taking advantage of. And I actually think having a combination of the two is the best way to go about it. Of course, everyone's split will be different, but some people I speak to have one or the other. But I just think by having both, most importantly, you can draw down on both pots in a more tax efficient manner when it comes to living off of them. But also if the government does come in and change one for the worse, then once again, you've got two pots. So if they come in and nuke ISAs, at least you've still got a workplace pension or a SIP or both that you can use. Now, I've banged on about workplace pensions quite a lot, so I'm gonna skip this one. But ultimately, as I've written here, I've got some bullet points. Your workplace pension is the sleeping giant, and it really is, because you're gonna have your contribution, which your employer's contribution, which you need to max and make the most out of, and tax relief. It is the biggest wealth building tool, and most people bury their head in the sand and just ignore it. If you've got old workplace pensions, use the government's pension tracing service to find them and try and consolidate those pots, I would say in most cases, into a low-cost SIP to get lower fees and better investment options, and so you're not adding to the lost pension stat, which is now £30 billion roughly in the UK. But always, before you move any pension, give the provider a call and make sure you're not losing out on any benefits, perks, guarantees, particularly if it's an older pension from the 2010s or the 2000s and before, because you don't want to give up on anything by moving the pot. An important point to make here is you don't, or how was the best way to say this? You probably don't need to do more. I mean, I'm probably guilty of, making videos and reels where I'm looking at new global funds and analyzing them. But ultimately, if you're in some sort of low-cost global fund or low-cost global stock and bond fund, life strategy fund, target date fund, whatever you're comfortable with, you probably don't need to do more. Of course, you can have other funds and other investments and stocks and some gold and some Bitcoin. Ultimately, as long as the bulk of your money is in some sort of low-cost diversified global fund, you're honestly 90% of the way there. And I think if you're in one that you like, that's low fee, that's diversified, and you've got that in your ISA and pension, that really is the backbone. And you're generally like 90% of the way there, I'd say, to building up a good pot over the long term, particularly if you're using ISAs and pensions and you have years of investing ahead of you. Well, just coming back to actually time in the market, and I think the problem with all of this, and I've written here, is selling is the hard part. Because even if you do have an inkling to time the market, you might think right now that the market is in a bubble. I mean, I don't know how many messages I've received over the last 9 years. I've been doing Making Money Simple since 2019 on my Instagram, and I probably got hundreds, if not thousands of messages. Every year I get a message, or every few weeks I get a message, the market's in a bubble, it's high, it's gonna crash. The problem is it's just impossible to know when, and I know I'm probably being a bit of a dead horse here, but let's just say the market's in a bubble, you sell today. When are you going to buy back in? If it falls by 10%, 20%, 50%, by the time it then falls, it might fall 15%, and you're going to buy in at a 20% fall, then it bounces back, and then it's a zigzag, and it's just impossible to know. So I'm sorry to bring up the first point I made in this video, but that is ultimately the reason why I just stopped investing into country funds, thematic funds, individual stocks, because I just can't time the market, and I just don't know when is going to be the best time to buy a country's fund or a stock. So the beauty of this global approach is you just keep feeding it. And mentally, I think if the market goes down, great, I can buy more units of the same global fund. And if the market goes up, then that's also great because I'm wealthy in paper. And hopefully the market goes up between me recording this and editing it, so I cross that 200K mark. And that's the third time I mentioned it, I know. Got to get the hat trick in. The last thing I wanted to say here before I let you go, and if you're still watching now, a massive thank you, I really appreciate it, is that it really is just very difficult to get rich quick. And I think it's almost impossible to do that through investing. To get rich quick, you either need to start a business and sell it, inherit money, or be an accountant online and make some spicy content, if you know what I mean. But in reality, it's very difficult to do, and often money that is made quickly is lost quickly. I mean, just look at the track records of athletes and lottery winners. All the data is there. Getting rich slowly, though, is genuinely very easy, particularly if you've got decades of investing ahead of you like myself. It's not sexy, it's not cool, but you really can secure your financial future by really implementing the things I've said in this video. Getting started, using the wrappers, being consistent, taking control of your workplace pension, trying to increase your contributions over time as you make more money in your career, hopefully, not trying to time the market, not trying to panic sell. They are all things that are boring, I know, but they will get you rich slowly over time, or definitely at least get you wealthier than had you just spent all your money on stuff you might not need. Maybe I'm firing some subliminal shots at myself there. Or secondly, by saving your money, which ultimately just loses out to inflation over the long term. Okay, relatively unscripted. That is everything I'd written down on my Google Doc. 9 years of investing now. It's pretty mental. I've got to nearly 200K invested. I mean, I never thought that, it's crazy when I think about it. I won't get all emotional on you. The most important thing, of course, is to actually, and I should have said it at the start, everyone's really clicked away now, is to stop waiting and start investing. And to be honest with you, I should have plugged this earlier on. If you do want the simplest way to invest in the UK, you can get this from Amazon and give it a read, and it should hopefully be a massive help. But yeah, I hope that's helpful. If you've got any questions at all, let me know in the comments down below. I'm happy to help. If you need an individual hand, you can go onto my website, makingmoneysimple.co.uk, and on there it lists exactly how I can help you out in a one-on-one setting or a group setting, depending on what you're looking for. But a massive good luck on your investing journey. If you've got any questions, again, just let me know. A massive thanks for watching, and I'll see you in the next video. I literally just repeated myself about 5 times there, didn't I? I really probably should script my videos a bit more. But thanks for watching and have a good day.